Okay, we're going to do question 3 from 2005, February 2005, and it's a straight corporations essay. It's actually not that difficult of an essay. You're not going to know that. There's another thing too is some people say, oh, this essay is a racehorse, this one's longer. There's no such thing. There is absolutely no such thing. I've seen corporation essays that contain many, many issues that seem to be that might push you over the hour. I've seen ones that keep you under the hour. Evidence, I've seen real easy evidence ones. I've seen evidence ones that just are a complete headache. The thing is, every essay is designed to be done in approximately an hour. Give or take 5 minutes here and there on the bar exam. You're not going to know which ones are which, so spend an hour on each one, do it right, and don't listen to all that nonsense that you hear from everybody that has no idea what they're referring to. So keep an essay within the hour. This one turns out to be a little bit, it takes about an hour. It'll take about an hour to do. Nevertheless, you're also not going to know that until you read the entire fact pattern, until you analyze it and you write it out. By that time, the hour's up. So that's always a good rule of thumb. Also, I generally don't like to do essays that are not very recent. Not that there are any difference in relevance, but this one has issues that I hadn't seen tested in a while, and it's a little bit of a uniqueness, although it does contain some of the similar issues that are always tested. I figured it was a good one to go through, especially when it has issues that I think are relevant to what might be on an upcoming exam. Okay, calls to the question. As among EC, Molly, and Ruth, how should Dryco's $50,000 in assets be distributed? So we want to split up $50,000. We have EC, Molly, Ruth. $50,000 Dryco's assets. Now, this issue also shows up under partnerships. And ironically, we have a partnership to start off here. And this was in 2005, before the examiner said that they would test partnerships and before they said they would test agency. But believe it or not, agency issues have been showing up throughout time, and partnership issues also have been showing up. So when they said they added that in 2007, to me it wasn't really it wasn't a big deal, because they'd always kind of had it in a roundabout way. They just decided to make it more expressed, like, oh, we're doing this now, so be a little bit more aware of what we're going to be doing. Okay, how are we going to split up assets? Well, that's easy. How do you split up a company's assets, whether it's a partnership? Number one, creditors. And we pay outside creditors first. Outside creditors are people that have no interest or no stake in the company or the partnership. Inside creditors inside creditors mean people like shareholders who loan company money. Because essentially, if you're a shareholder and you're loaning the company money, you're just loaning the money to yourself. Because you're the owner of the company. So that's why you get paid second. So an outside creditor is one with no ownership interest. No ownership interest. No ownership interest. Okay? All right, and inside creditors, and then the money gets split among shareholders by a percentage of how many shares they own. Partnership by their stake, their percentage. If you're a 60% partner, you have a 60% stake. The other partner has a 40% stake. Then any surplus is split 60-40. Makes sense. Okay, we already know that money's going to be split. That's not going to be a hard call to question answer. Number 2, on what theory or theories, if any, can Molly or Ruth be held liable owed to the balance to EC? So EC is going to be going after Ruth and Molly. How can they get after Ruth and Molly? We're going to find out. Okay. Molly and Ruth were partners in an operation of a dry cleaning store. Okay, notice that they're partners. And the thing about a partnership in comparison to a corporation is corporation has limited liability. You get behind that corporate shield. You're only liable up to the amount of your investment. Whereas if you have a partnership, you're jointly and severally liable for everything your partner does, and you have unlimited personal liability. This is why people want to incorporate, to protect their unlimited liability. So if you and I enter into a partnership, let's say that we want to buy real estate, and somebody gets hurt in that property, because we're a partnership, we're subject to unlimited liability. But if we had incorporated and someone got hurt, or maybe there's a fire, burns down the next house, maybe we don't have insurance, well, they're only going to be able to go after whatever the company has. So whatever money that we funded the company with, how much money we put in as our investment, if we are under the corporate shield, we're going to be able to protect our personal assets, and only what the corporation did is going to be liable. You see how if we were a partnership and something happened with the property where someone gets injured on it, someone gets injured on our property, if we're a partnership, both you and I are going to be unlimited personally liable. But if we were a company, we are incorporated, we had that corporate shield, our personal funds will not be getting touched, just the corporate funds, unless, of course, they pierce the corporate veil. That's why you want to observe corporate formalities. You want to be adequately financed, and you don't want to treat the bank as you don't want to treat the company as your piggy bank. You don't want to be siphoning off funds or mixing the personal and corporate assets. Recent government environmental regulations relating to dangers posed by dry cleaning fluids increase their exposure to liability, and cause a decline in their business. They decided to convert their partnership into Dryco, a corporation, to limit their limited potential liability. And limiting liability is one of the biggest advantages to incorporating. Molly and Ruth each contributed $20,000 in cash to Dryco. I'm going to put this up on the board now. You know, one of the things I look at is, well, they're telling us that this company, Dryco, has been properly funded. So when we talk about how do we get shareholders, because we find out that they're shareholders of the company, how are you going to hold shareholders personally liable? Well, one of the ways is you pierce the corporate veil. One of the things I said, instead of trying to memorize all the elements and factors and all that stuff, why not just read carefully, and when something triggers in your mind, oh yeah, looks like they each contributed. Looks like it's been adequately financed. Adequate initial capital. Cool. I like that. Adequately financed. The initial capital was, $40,000 is a lot of money. It's nothing to snicker at. Especially when some states only require a minimum of $1,000 to incorporate. Other states don't really care at all how much money you bring into the business. But $40,000 to me seems like a lot of money to invest as an initial investment. Okay. In return, each received a $15,000 promissory note from Dryco. So, and $5,000 worth of shares of stock at a value of $1 per share. It seems to be the par value. They're not getting into that. So they're inside creditors because they loan the company money. So each of them are owed $15,000 from the company. But if there's not enough money to pay off the top creditors, they ain't going to get diddly. Okay. Prior to incorporation. Now, prior to incorporation, they have not been incorporated yet, which means they do not have the unlimited liability that you get when you have the corporate shield. So they're going to be personally liable for any pre-incorporation contracts, and this has to do with promoter liability, and that's what we're going to end up here. Well, how is EC going to find them liable? Well, promoter liability. They entered into the contract themselves, and promoter liability is just simple contracting principles. Okay, Molly entered into a contract on behalf of Dryco, with Equipment Company for the unsecured credit purchase. That means she didn't put down any collateral. I don't know, maybe they put a fixture filing on this. Well, it's not a house, but there's some kind of filing I'm sure you can put. An unsecured credit purchase of an environmentally safe dryer for $100,000. Well, Molly entered into it. So how is Ruth going to be liable? Well, if they're partners, remember there's vicarious liability for partnerships. So all partners are vicariously liable. That's why you got to be careful who you partner with. Partnerships in business is the same thing as actual partnerships with spouses when you talk about community property. Because in California, under community property law, essentially a marriage is treated like a partnership. You're both equally liable. So if you run up a debt during the marriage, the community property could be liable, just like if one of the partners runs up a debt in partnership when the partnership's formed, then the partnership's going to be liable for it as well. You got to be careful who you partner with. Okay. Unsecured credit purchase of a safe dryer. And I said, but Ruth is vicariously liable because she and Molly are partners. EC was aware that Dryco had not been formed. So if EC was aware that Dryco had not been formed, then they're not relying on the corporate entity for payment. So corporation by estoppel is not going to apply, because one of the things with corporation as estoppel is when a third party contracts with a corporation, even though the corporation has been defectively formed, if they believe they're dealing with a corporation, they expect to get paid from the corporation. Therefore, they're not expecting personal liability from the shareholders. And if the corporation turns out to be defectively formed, the third party creditor can't say, oh, no, I'm going to hold you personally liable because the corporation is not formed. You're stopped. You're prevented from denying the corporate existence. We don't have that here because EC was fully aware that Dryco had not been formed and that their liability is going to be coming from Ruth and Molly as partners. So no corporation by estoppel. EC delivered the dryer 1 week after the incorporation, and Dryco used it thereafter. Okay, so we have promoter liability that makes Ruth and Molly personally liable because they entered into a contract with themselves as a partnership. Although I think who's the one who actually entered into it? It was Molly. Molly's personally liable. Ruth is also vicariously liable for Molly's actions as a partner. However, the question is the corporation going to be liable as well? Well, the corporation has not signed the contract. They weren't even in formation at the time. So how could they be liable? And that's the thing we're looking for, is adoption. They've adopted the contract. How did they adopt it? Well, they didn't expressly adopt it, which means there was a resolution by the board of directors where they put in writing, yes, we agree to take over this contract. And there's no novation because they didn't get together with EC and agree to release Ruth and Molly and only hold the corporation responsible. There was no novation, but there was an adoption. And what the adoption is, it wasn't express, it was implied. And what does implied means? It means they accepted the benefits of the contract. So they used the dryer in their business, and now all of a sudden they've adopted the contract and they become primarily liable. However, Ruth and Molly are still secondarily liable. They're not off the hook. There hasn't been an ovation. If there was an ovation, they would be off the hook. But that has not happened. Okay. So 1 week after the incorporated, Dryco used it, so they've impliedly adopted the contract, they accepted the benefits, and they made monthly installment payments. Okay, the fact that they're making payments shows that they're not only accepting the benefits of it, but they're acknowledging the fact that they have it and they're making payments. Also, they must be keeping enough cash on hand because they're meeting their debts as they become due. You know, if you look at other fact patterns where piercing the corporate veil comes in, like when it was, they made misrepresentation. There was one with the website one where they had lied about it. They were siphoning corporate funds. They were using it as their own personal piggy bank. They misrepresented the financial status, and it was a costly website where there was a complete injustice being done. Can you see that and contrast it here? These two girls started a business, tried it out for a year. It didn't work. They lost money. They also lost a lot of sweat equity that went into it for the amount of time they put into it. They adequately financed their business. They paid their debts as they became due. Whereas in the other fact pattern, that company just straight up lied and they had no plan on paying their creditors. So in that situation, it's more likely to pierce it. In this situation, it's looking less likely. Also, they're dealing with a contract claimant. Claimant, because EC aren't going to be able to pierce the corporate veil. Well, they're not going to need to anyways, but they're not going to. They knew what they were getting themselves into when they dealt with these girls. They knew the corporation had not been formed, which is the reason why you're probably not going to pierce it. But the examiners, believe it or not, were looking for that, oddly enough. And you see how many facts actually go to the elements or the factors what a court will use to pierce the corporate veil. Okay. DRYCO had been incorporated in compliance with all statutory formalities or requirements. So it's not a de facto corporation. You don't need to get into really a corporation by estoppel, although you can quickly dismiss it. Somehow the examiners were looking for that based on the fact that EC was aware they had not been formed. This is a de jure corporation, simple as that. Molly and Ruth observed all corporate formalities. Again, another factor, observed corporate formalities. I don't know about you, but I really don't memorize things. I do understand things very well. I understand these concepts. But the thing that really helps with doing essays, and I think students have such a hard time with it, and I don't understand why exactly, is my mind gets triggered when I see things. One of the best things you can do, instead of trying to make your own outlines or memorize law, or just blindly read words on a page, look at fact patterns. Going through essays, this is so helpful because you'll start seeing so many of the same fact patterns, and they'll keep repeating itself, and you'll keep getting your memory jogged. So if you're scared of essays, if you feel like you're not good with essays, then attack them. Then do more of them. And what I mean by do more of them is go through the model answers, go through the fact pattern, look at the critical breakdown, look at how things are put together, how it's an organization. They kind of organize it for you, for God's sake. But really just like spend the time, listen to the 10-minute audio, watch this. Obviously, if you are watching it, you're doing a good job. But you'll start seeing over and over the same fact patterns. And now you have something to relate it to, and you'll just notice the examiners really put everything there for you to discuss. So they observed all corporate formalities during DRYCO's existence. Because look, they're expecting a discussion of piercing the corporate veil, adequately capitalized, paying their debts as they become due, entered into a contract. So 1 year after incorporation, and a year is not a lot of time to be in existence, but keep in mind that most businesses fail within the first year. That's interesting. In fact, I was reading a study, I think it was 80% fail within the first 3 years, and more than half fail within the first year. 1 year after incorporation, DRYCO became insolvent and dissolved. Look, that stuff happens, and that's why you incorporate. So in case you go belly up and you can't pay your creditors, you got to dissolve. You end up winding the corporation up. You stop doing business, but you're not going to be personally liable. You're only going to be liable to your amount of investment. I mean, these girls put in $20,000 each. They're going to lose that money. Simple as that. Okay. At the time of dissolution, DRYCO's assets were valued at $50,000. All they have is $50,000. Its debt totaled $120,000, consisting of the $15,000 notes held by Molly and Ruth and $90,000 balance to EC. So over the course of a year, they're only able to pay off $10,000 plus interest. Okay, so we only have $5,000. How do we split it up? Well, that's easy. Or we have $50,000. How do we split up? EC gets it all, the outside creditor. They'll get $50,000. So now EC is still owed $40,000. Well, guess what? Ruth and Molly are going to be vicariously liable for that balance. How about that? Because they signed the contract before the corporation came into existence. They're personally liable. Now, granted, the corporation adopted the contract and they became primarily liable. Corporation only had $50,000 in assets, so that goes there. So EC is still going to look for its money. Hey, where's my other $40,000? Come knocking on their door. Okay, that's how that's going to end up. So 2 notes of $15,000 held by Molly and Ruth. And we got that. Okay, so as among EC, Molly, and Ruth, how should it be distributed? First of all, they're going to be able to get the full $50,000 because creditors, people that have no ownership interest, the outside creditors, they're paid first. They're an outside creditor clearly, and there's not going to be enough money to pay Molly and Ruth the $15,000 that they loaned the company. So you don't even have to get down to the rest of the prongs. And again, the corporation is going to be liable. The corporation has the $50,000. So in order for the corporation to be liable, they're going to be liable because they adopted the contract. And even if you put adoption in here, it doesn't really matter. Sure, it went in number 1, but I started putting it in number 2. But then I realized this has to do with Molly and Ruth and not the corporation, so I would move that over here. So the corporation has now adopted accepting the benefits of they impliedly adopted it. It was delivered to them. They had it at their place of business. They used it. They even made monthly installments, so they acknowledge it. So they clearly accepted the benefits. And the $50,000 that Dryco has will be used to pay EC. But then again, Molly and Ruth are still going to be liable for the rest of the 40. On what theories can Molly or Ruth be held liable for the balance? Well, promoter liability. Promoters are people that enter into contracts in order to bring the corporation into existence. And because they're entering into contracts on behalf of the proposed corporation, it's not in existence yet, they're personally liable for it. It's simple contract principles. That's all it is. Don't make it any harder than that. But here, so Molly entered into the contract before the corporation was formed, so she's personally liable. But because Ruth is her partner, Ruth is vicariously liable. And again, it looks like the answer, adoption, is discussed here. So again, it didn't really matter where you put it. Dryco is going to be primarily liable for the debt, which we've already discussed. And Ruth and Molly are going to be secondarily liable for the remaining $40,000. There's not going to be any corporation by estoppel because EC knew they weren't dealing with a corporation that had been formed. They were dealing with 2 individual partners. Piercing the corporate veil. Can you pierce the corporate veil here? Well, you're going to get it anyways by the adoption theory, but the corporation was adequately capitalized. There was initial capital investment was fine. They had enough cash on hands to pay their debts as they became due. As you know, they paid down $10,000 off the debt. EC was a contract claimant, and the girls observed the corporate formalities, so they'll be able to get the protection, although it's not going to do them any good because they signed the contract personally. And that's really it. That was a really limited essay. It had very few issues. And don't make up things that aren't there. If there's nothing else there, there's nothing else to discuss. And that's it. A lot of people sometimes will go, oh, I still have 5 minutes, and they'll start throwing. You don't need to do that. Make sure you read the facts carefully. You slow down because you're going to have enough time to actually slow down and see what the examiners are asking you and use the facts that are presented by it to help you not only jog your memory, but to get an accurate analysis. Okay, that's a wrap for 2005 February question 3, corporations. Thanks for listening.